A balance sheet is a financial statement that shows what a business owns and what it owes at a specific time. It's like a financial snapshot. On the left side, we see assets. That's everything the business owns. On the right side, we have liabilities and owner's equity. That's what the business owes and how much the owner has invested. This balance sheet shows the current year and the prior year for comparison. The total assets for the current year are $203,200, and the total liabilities and owner's equity is $179,700. These numbers help you understand the health of your business. Is it growing, or is it in trouble? By comparing this year to last year, you can spot trends and make better decisions. Let's talk about assets. Assets are everything the business owns that has value. In this balance sheet, assets are divided into three parts: current assets, fixed, long-term assets, and other assets. Current assets are short-term, things like cash, $25,000, accounts receivable, $50,000, and inventory, $20,000, all expected to be used or turned into cash within a year. Add them up, and current assets total $120,000. Fixed assets are long-term items like property, plant, and equipment, $18,500, long-term investments, $45,000, and less depreciation. These total $72,900. Finally, other assets, like deferred income tax and other items, add another $10,300. So altogether, the business owns $203,200 worth of assets this year, compared to $166,950 last year. That's growth. Now, understanding liabilities. Liabilities are what the business owes, its debts and obligations. These are split into current and long-term liabilities. Current liabilities are short-term, to be paid within a year, like accounts payable, $5,000, short-term loans, $12,500, and income taxes payable, $8,500. All these current obligations total $131,250 this year. Next, we have long-term liabilities such as long-term debt, $5,800, and deferred taxes, totaling $12,800. Combined, all liabilities amount to $144,050. Last year, liabilities were lower at $116,795. This means the company took on more debt this year, which could be for expansion, but we need to see if that debt is under control. That's why this balance sheet is important. It helps spot warning signs early. Owner's equity, the business value. Now let's look at the final section, owner's equity. This tells us how much of the business is owned outright by the owners after all debts are paid. It includes owner's investment, $11,000, retained earnings, $20,000, that's profit kept in the business, and other equity items, $4,650. Altogether, the equity for the current year is $35,650, which is slightly lower than the prior year's $36,300. This could mean more money was taken out of the business this year or that net profit was lower. Owner's equity is important because it shows how strong the business is financially. If liabilities are too high and equity is low, that's a red flag. A good business keeps building its equity over time. Ratios and final thoughts. Lastly, let's check out the financial ratios at the bottom. These help you analyze the numbers better. For example, the debt ratio is 0.71, meaning 71% of assets are funded by debt, higher than last year, which was 0.70. The current ratio is 0.91, which means the business might struggle to cover short-term debts with current assets. A healthy ratio is 1 or more. Working capital is minus $11,250, a negative number showing more liabilities than short-term assets. This might be risky. The debt-to-equity ratio of 4.04 means the business has 4 times more debt than equity. That's quite high. In summary, while the assets grew, the business also took on more debt. This balance sheet is your tool to understand where the business stands financially. Read it carefully. It tells a powerful story.